In the vast and often treacherous landscape of the financial markets, the search for success is a universal pursuit. Most who enter this arena seek a secret formula, a complex indicator, or a hidden piece of knowledge that will unlock the path to consistent profits. They believe the game is won through superior prediction. But Richard Wyckoff, after a lifetime of study and practice at the very heart of Wall Street, came to understand a more profound truth. He realized that enduring success in the market is not built upon the shaky ground of forecasting, but upon an unshakable foundation of timeless, inviolable rules. He taught that speculation, when correctly practiced, is not an art, nor is it a gamble. It is a business. And like any successful business, it must be operated according to a set of sound, logical, and unwavering principles. This video is a masterclass in those principles. We will distill the immense body of Wyckoff's work into 10 golden rules, the core commandments that transform speculation from a game of chance into a profitable professional enterprise. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The first and most important of all Wyckoff's teachings is this. Rule number 1, treat your trading as a business. This single principle is the foundation upon which all other rules are built. It is a fundamental shift in mindset that separates the professional from the 95% of the public who consistently lose money. The amateur treats the market as a hobby, a source of excitement, or a casino where he hopes to get lucky. He acts on impulse, on tips, on hope. The professional treats the market as his enterprise. He has a business plan, a methodology, and a set of disciplined procedures that he follows with the same seriousness as a manufacturer or a merchant. The philosophy behind this rule is that trading, when approached correctly, has all the characteristics of a business. It has revenues, which are the profits from successful trades. It has expenses, which are the small, controlled losses, commissions, and other costs. It requires capital to operate. It demands a period of apprenticeship and study to master its techniques. And its ultimate success or failure depends entirely on the skill, judgment, and discipline of its proprietor. Wyckoff himself exemplified this. He did not begin trading until he had spent 14 years on Wall Street, first as a runner, then as a clerk, and finally as the head of his own brokerage firm. He invested years in learning his business before he risked a significant portion of his own capital. He knew that knowledge was his most valuable asset. The practical steps to apply this rule are clear and non-negotiable. First, you must have a written trading plan. This is your business plan. It must define what markets you will trade, what your methodology is for identifying opportunities, how you will enter and exit positions, and how you will manage your risk. Second, you must keep a meticulous trade journal. This is your set of accounting books. Every trade must be recorded, along with the reason for entry, the stop-loss placement, the price objective, and the ultimate outcome. Third, you must conduct a regular business review. At the end of every week or month, you must study your journal, especially your losses. A loss, when analyzed, is not a failure. It is tuition paid to the market for a piece of valuable education. The trader who treats trading as a business learns from his expenses and constantly refines his methods to improve his future performance. From this foundational mindset flows the second golden rule, a principle of capital management designed to prevent the most common cause of financial ruin on Wall Street. This is rule number 2, never overtrade. Wyckoff observed that more accounts were destroyed by this single error than by any other. Overtrading is a two-headed monster. It means, first, trading in a position size that is far too large for your available capital. Second, it means trading too frequently, making commitments without a sound, logical reason based on your proven methodology. The philosophy here is that overtrading is the enemy of mental poise. When a man is risking an amount of money that makes him anxious, he cannot think clearly. He is no longer an analyst. He is a gambler, riding a wave of fear and greed. He will cut his profits short at the first sign of a minor reaction, and he will let his losses run in the desperate hope that they will turn around. He has lost the emotional detachment that is essential for professional judgment. Wyckoff saw this happen countless times. A trader, flush with a recent success, would become overconfident and dramatically increase his trading size, only to be wiped out by a single unexpected market move. The practical steps to avoid this are rooted in strict capital allocation. First, you must define your risk per trade as a small, fixed percentage of your total trading capital. A common professional standard is to risk no more than 1 or 2% of your capital on any single trade. Second, you must have the discipline to remain idle when your method does not provide a clear, high-probability setup. The professional understands that his job is not to trade every day, but to wait patiently for the rare moments when the odds are overwhelmingly in his favor. He knows that the profits are made in the waiting, not in the constant action. By controlling your position size and your frequency of trading, you ensure that your business can withstand the inevitable strings of losses and survive to trade another day. This leads directly to the third and perhaps most critical rule of survival in the markets. This is rule number 3. Always limit your risk. While rule 2 deals with the size of your commitments, rule 3 deals with the ironclad defense you must place around every single one of them. For Wyckoff, the use of a stop-loss order was not a suggestion. It was an absolute law. It is the single action that separates the professional business owner from the hopeful amateur. The philosophy of the stop-loss is that it is an insurance policy. It is a prepaid, non-negotiable business expense. Wyckoff taught that the trader must accept the fact that he will be wrong, and often. The stop-loss is the plan for what to do when that happens. It is a decision made with a cool, clear mind before a trade is entered, to be executed mechanically and without emotion when the market proves the initial judgment to be incorrect. It is the ultimate tool for preserving capital, which is the lifeblood of the trading business. To trade without a stop is to leave your entire enterprise exposed to a catastrophic business-ending event. The practical step is to determine the logical danger point for every trade. A stop-loss should not be placed at an arbitrary percentage or point level. It must be placed at the specific price that, if reached, conclusively invalidates the original reason for the trade. For a long position taken after a spring, the stop is placed just below the low of that spring. For a short position taken after an upthrust, the stop is placed just above the high of that upthrust. The placement of the stop is a technical decision based on the structure of the market. Its execution, however, is a matter of pure discipline. A professional never moves his stop to accommodate a larger loss. He accepts the small planned expense and moves on. The fourth golden rule is a direct consequence of the third. It is designed to prevent one of the most common and destructive reactions to a losing trade. This is rule number 4, never average down. This is the practice of buying more of a stock as its price falls, in the hope of lowering one's average cost. Wyckoff considered this to be one of the most pernicious and logically bankrupt strategies in finance. The philosophy here is simple and brutal. Averaging down is the act of doubling down on a mistake. Your initial judgment to buy the stock has been proven wrong by the market's own action. The price has declined. To then commit more capital to this failing venture is to abandon all logic and act purely on hope. You are, in effect, arguing with the tape, and the tape always wins. Wyckoff pointed out that the trader who averages down is often buying from insiders who are selling for very good reasons. He is not getting a bargain. He is taking on someone else's problem. The practical step is to replace the impulse to average down with the discipline of the stop-loss. When your initial judgment is proven wrong and your stop is hit, your job is not to buy more, but to liquidate the position immediately. You must then analyze the trade to understand why your judgment was wrong. Was your analysis flawed? Did you misread the market? Did you act impatiently? By replacing the destructive habit of averaging down with the constructive habit of analyzing your small losses, You turn a potential catastrophe into a valuable learning experience. The professional adds capital only to his winning trades, a concept we will explore later, never to his losers. The fifth golden rule ties the concept of risk directly to the potential for profit. It is the ultimate test of a trade's viability as a sound business proposition. This is rule number 5. Ensure the potential reward outweighs the risk. Wyckoff was a strong advocate for only taking trades where the potential profit was at least 3 times the initial defined risk. The philosophy of this rule is that trading is a business of probabilities. Since losses are an inevitable part of the process, the profits from the winning trades must be significantly larger than the losses from the losing trades for the enterprise to be profitable over the long term. The 3-to-1 reward-to-risk ratio is the mathematical foundation that makes this possible. It allows a trader to be wrong on a significant number of his trades and still build his capital. The practical steps for applying this rule are a core part of the pre-trade routine. First, the trader must identify his risk. As we have discussed, this is the distance from his planned entry point to his logical stop-loss point. Second, he must identify his potential reward. This is done by projecting a reasonable price objective for the move, most often by using the point and figure counting method to measure the cause that has been built. Finally, he divides the potential reward by the defined risk. If this ratio is less than 3-to-1, the trade is passed over without a second thought. This single discipline forces the trader to be highly selective. It filters out low-quality, marginal setups and compels him to wait patiently for the A-plus opportunities, where the market structure offers the potential for a large gain from a point of small, well-defined risk. This is not just a trading rule, it is the essence of sound business management. Having established the foundational rules of survival and sound business management, the principles that protect a trader's capital and ensure his longevity in the market, we now transition to the rules of professional operation. These are the principles that transform a defensive, survival-oriented mindset into a proactive, profit-seeking one. These are the rules that govern market analysis and trade execution. They are the active skills that, when built upon a bedrock of sound capital management, allow the Wyckoff analyst to move from simply staying in the game to winning it. This is the professional's approach to reading the market and acting upon its clear and logical testimony. This brings us to the 6th golden rule, which is the very heart of the Wyckoff analytical philosophy. This is rule number 6. Judge the market by its own action. Wyckoff taught that all the information a trader truly needs to make a sound decision is contained within the market's own behavior. The endless stream of news, rumors, earnings reports, expert opinions, and economic forecasts that captivates the public is, to the professional, little more than noise. He understood that these elements are often misleading, frequently late, and sometimes deliberately manipulative. The true story of a stock's future is told not in the headlines, but on the ticker tape. The philosophy behind this rule is that the market is the ultimate clearinghouse for all information, both known and unknown. The price and volume of a stock represent the final distilled judgment of every force acting upon it. The hopes, fears, and analyses of thousands of traders, and most importantly, the well-informed campaigns of the composite man. The large operators, with their vast resources and deep connections, are always the first to know of any significant change in a company's fundamentals. They do not wait for the news to be published. They act upon their knowledge long before it becomes public. Their actions, their buying, and their selling are what create the price and volume patterns that the Wyckoff analyst learns to read. Therefore, to study the action of the market is to study the actions of the smart money. The tape, he argued, tells the truth, even when the news does not. The practical steps for applying this rule form the basis of the entire Wyckoff method of technical analysis. First, the trader must learn to read the price action. This means understanding the significance of price swings, the meaning of a stock's ability or inability to rally or react, and the classic structural patterns of accumulation and distribution. He must learn to define the trend by observing the sequence of higher highs and higher lows in an uptrend, and lower lows and lower highs in a downtrend. Second, and even more critically, he must learn to read the volume. Volume is the force, the effort that drives the price. By studying the volume in relation to the price movement, the analyst can determine the character of the action. Is a rally supported by strong expanding volume, confirming its legitimacy? Or is it occurring on light, diminishing volume, signaling a lack of demand? Is a decline happening on heavy, aggressive volume, indicating a flood of supply? Or is it a quiet drift on low volume, suggesting a simple lack of buying interest? This interplay between price and volume is the language of the market. Third, the analyst must consider the element of time. How long does it take for a stock to rally a certain number of points, and how long does it take for it to react? A slow, labored advance followed by a swift, sharp decline is a sign of weakness. Conversely, a rapid advance followed by a slow, drifting reaction is a sign of technical strength. By focusing exclusively on these three elements, price, volume, and time, and ignoring the distracting noise of news and opinion, the trader aligns himself with the reality of the market, not with the public's perception of it. From this analytical foundation, we derive the seventh golden rule, which dictates how the trader must position himself relative to the market's primary force. This is rule number 7. Trade in harmony with the market. Wyckoff taught that arguing with the trend is a losing proposition. The individual trader, no matter how well capitalized or intelligent, is a small boat on a vast ocean. The market's primary trend is the powerful underlying tide. To attempt to trade against this tide is to exhaust one's capital and energy fighting an insurmountable force. The greatest and most consistent profits are always found by identifying the direction of this tide and moving with it. The philosophy here is the concept of the path of least resistance. A stock that is in a confirmed uptrend has a natural upward bias. The forces of demand are in control, and it requires less energy for the stock to continue moving higher than to reverse. Conversely, a stock in a downtrend has a natural downward bias. The forces of supply are in control, and the path of least resistance is to the downside. The professional operator does not try to be a hero, catching the exact bottom or shorting the exact top. Instead, he waits for the market to clearly signal its direction, and then aligns his commitments with that established trend. He seeks to profit not from his ability to predict the future, but from his ability to correctly identify the present. The practical steps for applying this rule begin with a top-down analysis. First, the trader must determine the trend of the general market. Is the overall market tide coming in or going out? Wyckoff used his analysis of the market averages to answer this question. If the market as a whole is in a confirmed uptrend, the trader should favor long positions. If the market is in a downtrend, he should favor short positions or remain in cash. Second, he must select stocks that are moving in harmony with the general market, and ideally are demonstrating superior comparative strength. In a bull market, he looks for the leaders, the stocks that are rallying more strongly than the average and reacting less. In a bear market, he looks for the laggards, the stocks that are declining more sharply than the average and rallying more feebly. By doing so, he ensures that his capital is deployed in the vehicles that are most responsive to the market's primary trend. Trading in harmony with the market is a simple but profound principle that dramatically increases the probability of success. Once a trader has aligned himself with the trend and entered a profitable position, he is faced with one of the most difficult psychological challenges in the market. This brings us to the 8th golden rule, the offensive principle that is the key to capturing large gains. This is rule number 8. Let your profits run. The natural tendency of the amateur trader is to snatch a small, quick profit. He is driven by the fear that the gain will evaporate. A 2 or 3 point profit feels like a tangible victory, and he rushes to secure it. In doing so, he constantly violates the fundamental business principle of making his winning trades significantly larger than his losing trades. Wyckoff observed that the great fortunes of Wall Street were not made by scalping small profits, but by having the courage and patience to ride a major trend for a substantial move. The philosophy behind this rule is a direct extension of the previous one. If you have successfully identified the primary trend and have entered a position in harmony with it, your most logical course of action is to stay with that position until the evidence indicates that the trend has run its course. A healthy uptrend can continue for weeks, months, or even years, and the profits that can accrue from riding such a move are exponentially greater than any that can be made from in-and-out trading. This requires a shift in mindset, from the fear-based action of taking a quick profit to the confidence-based patience of managing a winning campaign. The most practical step for applying this rule is the disciplined use of the trailing stop-loss. As we have discussed, after a stock in an uptrend makes a new high and completes a normal, healthy reaction on diminished volume, the stop-loss order is moved up to just below the low of that reaction. This technique is the mechanical embodiment of the rule to let profits run. It allows the trader to remain in the position and endure the normal, minor pullbacks that are a necessary part of any sustained advance. It prevents him from being shaken out by his own anxiety. At the same time, it systematically locks in a greater and greater portion of the profit as the trend progresses. This method removes the emotional question of, when should I sell? And replaces it with a logical, systematic process that forces the market itself to prove that the trend is over. The ninth golden rule governs the art of timing one's entry into the market. It is a principle built upon the virtue of patience, a quality that is essential for professional success but almost entirely absent in the amateur. This is rule number 9. Wait for confirmation. Wyckoff taught that it is not enough to simply have a correct analysis of a stock's potential. The trader must wait for the market itself to confirm his judgment before committing his capital. The desire to act on a conclusion prematurely to get in before the real move begins is a costly impulse. The philosophy here is that the market is the ultimate arbiter. A trader may believe, based on his analysis of an accumulation range, that a stock is preparing for a major advance. But this is merely a thesis. It is not a fact until the market confirms it. The professional operator does not act on his opinion alone. He waits for the evidence to validate his opinion. This patience protects him from a multitude of errors. It prevents him from buying too early in an accumulation range, only to be shaken out by a final spring. It prevents him from buying into a false breakout or upthrust. It keeps his capital safe until the moment of maximum opportunity and minimum risk is at hand. The practical steps for applying this rule involve identifying the specific technical events that constitute confirmation. In the Wyckoff method, the most powerful confirmation that an accumulation phase is complete is the jump across the creek, followed by a successful backup to the edge of the creek. This sequence of events is the market's clear signal that the preparation is over and the markup has begun. The patient trader waits for this confirmation. He may miss the first few points of the move, but he enters the trade with a much higher degree of certainty and at a point where a clear, logical stop can be placed. He sacrifices the satisfaction of buying at the absolute bottom for the professional assurance of buying at the correct time. This leads us to the final and perhaps most masterly of all the golden rules. It is a principle that requires the utmost in self-control and discipline, and it is the ultimate sign of a professional operator. This is rule number 10. Know when to be neutral. The amateur feels a constant urge to be in the market. He believes that if his money is not invested, it is not working. He equates action with progress. The professional, however, understands that a neutral position, being entirely in cash, is a powerful and often highly strategic position. The philosophy behind this rule is that high-probability trading opportunities are rare. The market spends a great deal of its time in periods of unclear, choppy, and unpredictable action. During these times, the odds do not favor either the bull or the bear. To trade in such an environment is to gamble. The professional knows that his capital is too precious to be risked on low-probability setups. He understands that his primary job is not to trade, but to wait patiently for those moments when the market's message is clear and unambiguous. The practical step is to cultivate the discipline of inaction. When the trader's analysis of the market averages is unclear, when no individual stocks are presenting clear signs of accumulation or distribution, or when his own judgment is clouded by recent losses or emotional stress, the correct course of action is to do nothing. By moving to the sidelines and holding his capital in cash, he achieves several crucial objectives. He preserves his capital, protecting it from the erosion of indecisive whipsawing markets. He clears his mind from the constant noise of the ticker, allowing him to regain his objectivity. And he positions himself to act with maximum force and clarity when the next true opportunity finally presents itself. The ability to sit patiently and wait is one of the most difficult yet most profitable skills a trader can ever learn. For those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, with complete explanations that make Wyckoff's timeless wisdom more accessible than ever. For anyone who wants to truly absorb the lessons we are discussing, this adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. In conclusion, these 10 golden rules form a complete and cohesive philosophy for success in the financial markets. They are not a collection of disparate tips, but an integrated framework for thinking and acting like a professional. They begin with the foundational mindset of treating trading as a business. They establish the defensive principles of capital preservation through risk limitation and the avoidance of common ruinous errors. And they lay out the offensive strategies for correctly analyzing the market and managing profitable campaigns. Taken together, they provide a clear path. The true secret to success, as Richard Wyckoff taught, is not a complex algorithm or a hidden formula. It is the unwavering day-to-day discipline of applying these sound, logical, and timeless business principles.